Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller with Fed speakers back in action. We have a lot to talk about in bonds today.
Oh, big time. We also have CPI on Wednesday, so a lot to look forward to.
Absolutely, a lot to look forward to. Let's get now to the biggest stories in the more than $10 trillion global ETF industry. For the next half hour, we're going to be speaking with Salim Ramji. He's the global head of iShares and index investments at BlackRock for a wide-ranging interview about the industry.
And with BlackRock being one of the many funds refiling for a spot Bitcoin ETF, we're going to speak about the impact of the race on the industry, Matt.
Plus, as active ETFs continue to outperform, we'll look to see whether this remains an area of focus for BlackRock or whether they'll even ramp it up. All that and so much more coming up.
And Matt, as always, Eric Balchunas from Bloomberg Intelligence is with us now. He's looking at the flows. Eric, what do you got?
Katie, Matt, thank you. So we talked over the last few weeks about all this money coming back into equities. It's still happening. It's a little lighter than it was over the past few weeks, but definitely the big story this summer is the end of the FOMO drought. People have FOMO again. They're buying equities. You get the Qs at the top. That's a really good sign. IVV, so those are the two big indexes for U.S. equities. You got TLT and SGov, so still some bond buying. That's interesting. We hadn't seen bonds on there in a while. And then you've got RSP, which is equal-weighted S&P. So people sort of picking different versions of their equity exposure. The outflows, we do have a couple risk-on ETFs seeing outflows like HYG is at the top there, SPY, but then there's some outflows from GLD and a couple bond ETFs. So it's a little mixed. It's not as strong as it was last week in terms of bullish sentiment, but it's still net positive. So let's check into our famous FOMO drought indicator, which my colleague Andre Yap just made and updated. This is the difference between equity inflows and bond ETF inflows, right? So here's 0. If it's above, it means equities are taking in more. So this is a rolling number. And so during the FOMO drought, when people were attracted to bond yields, people bought fixed income ETFs more than equities. But then equities started performing, people come back in. This is all equities, including international. That passed 0 2 months ago. But U.S. equities have now just passed U.S. bond ETFs in terms of flows. And that's big because U.S. equities typically are in the driver's seat, and now they are back.
All right. Eric, thanks very much. Let's talk about that right now with Salim Ramji. He is the global head of iShares and index investment over at BlackRock, and we're pleased to have you for the half hour. Thanks so much for coming in. What do you think about this return to U.S. equities that Eric is illustrating there? Does it have legs?
I think it does. Look, when I was last on the show, I think at the end of last year, we talked a lot about bonds and bond ETFs. And it's certainly been a record first half for us in bond ETF flows. But a lot of that was just investors getting back to rebalancing their portfolios from underweights that they had at the beginning of the year. And they're still doing some of that in their portfolios. But I think around equities, some of it has been the resurgence in things like the S&P. But I think underneath it is just investors realizing that in a portfolio, you need both. And there's no one exact moment to time the market, but it's how to get good balance in your portfolios. And that includes U.S. equities, it includes fixed income, and it includes a whole range of things kind of well beyond that in international markets and in some of the things like active ETFs that you talked about as well.
And Salim, I'm really excited to get into fixed income ETFs with you, but we have to start with the Bitcoin filing. Of course, BlackRock really made waves and then some with that mid-June refiling for a spot Bitcoin ETF. And I think we've all learned a lot about surveillance sharing agreements in the past couple of weeks. I want to talk about the fact that it's a partnership with Coinbase. Why is Coinbase the right partner here?
Well, Katie, and you'll forgive me because I'm limited in what I can say because there is a live filing around it. And so let me try and answer your question with two broader answers, which is the first one is that the underlying technology that underpins Bitcoin and the blockchain technology is something we're incredibly excited about. And we're incredibly excited about it because it removes frictions, or at least has the promise of removing frictions across the ecosystem. And for us in the role that we play, which is all about how do you take out friction in the ecosystem, whether it's a custodian, whether it's trading and settlement times, I think the underpinnings are really, really powerful for us. So that really sparked our interest in this whole area a number of years ago. And the second thing is all about access. So nearly 20 years ago, we launched our gold ETFs. And the gold is held in custody in a vault, which is remote from us, but it's now easier to transact in gold using our gold ETFs. And we're applying that same philosophy to other new and emerging asset classes like Bitcoin just as we did to gold 20 years ago, just as we did to bonds 20 years ago. So I know that doesn't answer your question.
Almost.
But we really just see this as about how do we embrace new technologies that are trying to reduce friction, and how do we help investors gain access to parts of the market that had otherwise been more difficult or really expensive or opaque for them to access otherwise.
And this is generally what ETFs do. They go into new asset classes. They usually start out a little on the pricier side. Cost competition comes in, liquidity comes in, and then you have this sort of investor utopia where you got cheap ETFs that all trade at a basis point spread.
Yeah.
And I just think that the crypto community is underestimating how powerful ETFs are. And it's going to be a real cost pressure mechanism, I think, for the exchanges, given it's going to trade at a basis point. Larry Fink was in an interview last week, talked about making it cheaper. Where do you think we'll see the expense ratio on some of these over the next couple of years? Do you think we'll get down to gold where it's like 23, 35 basis points?
Who knows? Lower is the answer. And if history is any guide for us, it just keeps getting lower as we see more and more investor demand. So even if you think about last year, Eric, when inflation was far higher all across the world than it is today, we reduced prices on 50 of our ETFs. And over the past 5 or 6 years, we've reduced prices by about $600 million across our ETFs. And so I think we've got a pretty good track record of being able to build scale in different products, but then pass on those scale benefits to clients, whether it's in gold, whether it's in bonds, or whether it's in any kind of asset class that we operate in. And that's part of the reason why more and more clients want to do business with us.
Just to wrap this up, we also have a program called Bloomberg Crypto on Tuesdays at 1 p.m.
Right.
So we're obsessed with this issue. I ask everybody, why would the SEC be opposed to a Bitcoin ETF, since it's pretty clear that the FTC considers Bitcoin a commodity, unlike other coins? And the answer I get most often is concern about market manipulation. How do you make sure that that doesn't happen, or how do you monitor the potential? And are you more worried about market manipulation in Bitcoin than you would be, say, in silver or gold?
Look, we're always keeping our ears to the ground in terms of what clients are looking for and what regulators are looking for. And our regulators play a really, really important role in the marketplace in terms of investor protection. And so we're always trying to balance both of those things. And so again, I'm not going to answer your question directly because I can't at this moment in time. But I think it's those dual forces around how are you able to deliver something of value to clients in terms of efficiency, in terms of access, and how are you really responsive to regulators who have an important role to play in terms of investor protection. And those are the two things that are always top of our minds whenever we're thinking about a product, whether it's around crypto, whether it's around gold, whether it's around bonds, equities, anything.
Mm-hmm. We could spend literally the whole 30 minutes just asking you about Bitcoin ETFs, but let's broaden out here because it's been a really interesting flow picture so far this year.
It has.
As Eric walked us through. If I look at BlackRock overall ETF flows, I think you've taken in something like $26 billion so far this year into your US ETFs, and that's down pretty dramatically from prior years. And of course, this is an industry-wide sort of story, but specific to BlackRock, because if I look at 2022, you took in nearly $170 billion. How do you explain sort of that drop-off in flows? What do you think is going on here?
Yeah, some of it is kind of straightforward to understand. We have within iShares a very seasonally oriented business. And so we tend to do much slower business in the first quarter, and we tend to do a lot of our business in the fourth quarter. And that's been true over long periods of time. And so when you look at the seasonality of it, a lot of financial advisors do their year-end tax planning, do their year-end portfolio rebalancing, and then they trade out of things come the beginning of the year. And this year's no different than other years. I think the thing that makes us really optimistic, not just about the end of this year, but about the end of the year after and the end of the year after that, is that in every period of volatility that we've seen and observed over the past 10 or 15 years, ETFs tend to do better and iShares ETFs tend to do better, because investors are always looking to rebalance and come out of things that are perhaps less efficient or less tax efficient and move into things that are more transparent, more convenient, more efficient to do business in. And so last year, we saw $900 billion of flows going in globally into ETFs in one of the most difficult market environments for equities and fixed income. And this year, not just in the United States, but all around the world, we're seeing about just north of $70 billion of flows into iShares kind of broadly. And we're also seeing investors all around the world looking to us for bonds, looking to us for equities, looking to us for some of these more novel exposures that we've put out in the marketplace over the course of the past year.
We're going to talk about that when we come back, because you think that bonds, ETFs could be really the great equalizer in terms of generating wealth. I also want to talk about buffers, which are kind of new and exciting, and maybe just the E in ESG. Salim Ramji, you're going to stick with us. We're going to talk more about all that coming up. This is Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with junk bond outflows. We're taking a look at HYG here. Of course, this is an iShares product. Last week, on a single day, it saw over $1 billion in outflows. That is the biggest one-day withdrawal since the banking crisis that we saw in March. So clearly, some of that demand starting to ebb. We'll see if that continues. But we know where that money is going, and some of it, at least, is going into cash. Here's another BlackRock product. It's almost like I planned this. You were looking at SGov here. So it's 0 to 3 month Treasury bills. That's what it tracks. It took in nearly $600 million of inflows last week. That is the biggest weekly inflow since March. So we'll see if that dynamic continues. But of course, one of the biggest stories this year is active ETFs, Matt, and that's where I want to end, because we're talking about BlackRock. Of course, it's the biggest ETF issuer, not really known necessarily for its presence in active ETFs. And we know that active ETFs have been all the rage. You're looking at the percentage of flows that they've taken in this year, 30%. That is by far a record, Matt.
Yeah, absolutely. Active has been the hot spot in ETFs. We're back with Salim Ramji, global head of iShares and index investments at BlackRock. And why don't we start right there? I mean, active is something that we talk about every single week, but typically it doesn't involve BlackRock.
Right.
You don't have a huge pool of products in this space. Is that on purpose?
No, look, we've got about $13 billion in aggregate in our BlackRock branded active ETFs and a couple of dozen products. And I'm a big believer in the future of active ETFs for some of the reasons, Eric, you talked about before, which is just the wrapper can do more and more across all kinds of public investments. And that includes active risk-taking ETFs, things like factors, for example, but it also includes active ETFs themselves. And I think what also fuels my optimism is just about a month ago, we launched 2 active ETFs, which were run by 2 leaders of our fixed income platform, Rick Reeder, who I think is going to be joining you guys in a couple weeks.
Fingers crossed.
And also Tony DeSpirito, who leads our fundamental active equity platform. And I think more and more, we just see this as another wrapper and another way for investors to be able to consume investing. The ETF happens to be transparent, it happens to be more convenient, and we're already seeing demand from financial advisors who are building models with ETFs and now want to build models with active ETFs as well as index ETFs. So yes. I think those charts are going to continue to go up.
I do too.
Kind of over the course of the next several years.
They were around for 10 years. Active ETFs are not new. They just started taking off. We've studied why.
Yeah.
My thesis is the fees finally got beta adjusted. You're just paying for the active. So if you have a low active share and you look like the benchmark, you got to lower your fee. So all the stuff under 40 basis points is really selling. And I think advisors like active, they're open to it. But now that beta is free, they don't want to pay for the beta. They just want to pay for the active. So you got to be cheap, or the other direction, total high active share, like ARK. What do you say?
Yeah, I think it's all about how these fit in a portfolio. So think about Rick's new fund, the BlackRock Income Fund. One way to look at it is to look at it through the lens, Eric, you talked about. The way that we look at it within BlackRock is that you can pair these exposures really well with broad-based exposures like the universal or like the ag, because where BlackRock Income is trying to find underlying alpha is in places like emerging markets or places like high yield where security selection really matters. And so both of them work well in a portfolio. And it's through that lens of a portfolio and a model portfolio that we're really looking at what are the right pairings, what are the right complements to underlying exposures. because advisors, particularly wealth advisors in the United States, they're telling us they want both. And they have increasingly a bias towards the convenience of an ETF wrapper because it's transparent, because it settles well, because like they're used to using it. And they just want it for a whole range of exposures, whether that's an iShares exposure or a BlackRock exposure managed by Rick or managed by one of our other active PMs.
You brought up model portfolios, and I'm going to try to connect two thoughts here because to this conversation on active that we're having, it's worth pointing out that a lot of the passive products that you have are used for very active purposes. And when we think about model portfolios, it's kind of frustrating as a journalist because it's hard to get really good numbers on the growth there. But how big of a business is that for you at this point? It's a massive business, Katie. It's a, for us, just about 2 years ago, it was something like a third of our flows within US iShares. And last year, it was more than half of our flows for US iShares. And so while I'll often get questions about this product or that product or this ticker or that ticker, the reality is, at least in the United States, the way we're representing and the way that we're talking about our ETFs is through the lens of a client's portfolio. And we think that's certainly important as a fiduciary because that's what they're trying to solve for. They're not trying to solve for, this versus that. They're trying to solve for what are the right mixes of this and that. And the second piece is that in terms of the scale effects for us, we can do a lot more by really looking at this through the lens of a portfolio, and we can gain a lot more in flows and we can gain a lot more in assets as a result of it. Now, even if I give you just 2 weeks ago, we'd hosted a conference at BlackRock for all of the model providers out there. Right. There are like 170 people, and many of them were BlackRock's direct competitors, but they're also iShares clients. And so we do a lot of business with people who are building models. They could be other asset manager CIOs, wealth managers, our client CIOs. We run our own model portfolios. And so this is a $4.2 trillion system that we think is going to be a $10 trillion system. It's going to be massive. Yeah. And it's the way in which more and more fiduciary advisors are doing business. And as a result, that's the way in which we're doing business with them. Really, really quickly, what's the timeline on that $10 trillion? On the $10 trillion, it is over the next 5 years, so by 2028.
Wow.
That's a good headline.
That's bullish.
Yeah. And it's bullish, but it's what I'd say is that we're seeing it every single day. Yeah. Like we started to see it 2, 3, 4 years ago. I think I'd mentioned like 6 years ago when we had our first models conference, we couldn't fill a small conference room. Yeah. And 2 weeks ago, we filled a whole auditorium. And so it's really just changed from being a cottage industry to being something that's a real force for every fiduciary wealth advisor in the United States. And we think over time, fiduciary advisors in Europe, fiduciary advisors in Japan, and in markets all across the world. All right, Salim, we got to take a break because coming up, we're going to be talking more about BlackRock's ETF business when it comes specifically to bonds. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence. Back with us now for today's drill down where we focus on one ETF. Eric, hit it.
Today we're looking at IUSB, which is the iShares Core Total Bond Market ETF. This is sort of a bigger, better version of the AG, in my opinion. This is the universal index. It came out, I don't know, about 10 years ago. It's only 6 basis points. And you get a lot for this. $22 billion, up from $6 billion only 3 years ago. So one of the fastest growing bond ETFs. Let's look at this versus the AG. Basically, the AG's like mostly government bonds. It's weighted by debt. It's easy to beat if you're a bond manager. With here, IUSB, you get less government, more corporate, more high yield, more international, little doses, and you get more bonds. And it yields a little more. So with just a little extra risk, you broaden out your portfolio. Let's look at this versus AG. And the PIMCO Total Return Fund, which to me would be like the average bond manager. And you can see the bond managers tend to beat up on the AG, but they don't beat up on IUSB because they use credit, high yield, and international, which this already has. So, Katie, I think this is a bigger, better benchmark for bond managers, as well as a good core for the portfolio for people who are looking for that broader exposure.
Well, let's ask the man himself, because back with us is Salim Ramji. He is global head of iShares and index investments at BlackRock. When you think about IUSB versus the AG, I mean, is IUSB the better benchmark?
IUSB is certainly the broader base benchmark. And I think that for investors who are looking for core plus holdings, it adds the plus as Eric talked about, in high yield and in international. And so I certainly think it's a more representative benchmark of the broader based bond market than things like the ag would be. But both have an interesting role in portfolios. And it's really back to what the client's looking for. But what we're always looking for is how do you slice different parts of the bond market in ways which can benefit investors. We're always looking to make improvements in the underlying indices and also be able to give investors different parts of the yield curve, different parts of credit, aggregated up, disaggregated, so that people can be able to build the portfolio they want. So we have like 500 bond ETF selections now, which is like 3 times as many as we did a few years ago. And so it's how do you piece all these different things together? But I think IUSB plays a very broad role in a portfolio for investors who want it. I think, Eric, you summarized it great in terms of like the benefits of it.
Yeah, but let's talk about it versus bond managers, because if you compare IUSB versus bond managers in that category, their beat rate goes from like 67% to like 40%.
Yes.
They look more like equity managers.
Yes.
And so I have this theory that the reason bond managers haven't seen the outflows that have gone to passive, like on the equity side, is because they just have a better, easier benchmark to beat. The ag to me is like the Washington Generals. I mean, it's like it's very easy to beat. Don't you think IUSB or that benchmark should be moved over as something to compare active to?
Well, you know, in the Core Plus universe, it already is, or it already can have that potential for a number of active bond managers. But look, the really interesting thing from my perspective is that some of our biggest clients are active bond managers. 9 of the 10 biggest active bond managers are clients and use our ETFs. And I think it was a moment of joy when I was looking at watching your show the other day, and you had the founder of PIMCO, who was talking about how he uses bond ETFs, thankfully iShares bond ETFs, as part of the investment process that he operates under, which is revolutionary to what might have been the case 10 years ago or 15 years ago. And when you all speak to Rick, that when it was just 1 out of 10 bond managers using iShares, it was Rick. And that's become a really mainstream practice. So I think you have 2 effects going on. One is that the power of data is always improving the indices, and we're always making it better for investors to be able to invest in new and better crafted indices. That's something that we've been doing since the inception of iShares, and we're going to continue to do. And second is active bond managers themselves are using ETFs as part of their process.
Salim, great having you on. Thanks so much for joining us. Salim Ramji from BlackRock. This is Bloomberg.